Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Could you talk a bit about your investment style and journey from being the Ben Graham deep value investor and now recently you too investing into great compounders? Could you explain to our listeners what is deep value, what are great compounders, and why did you make the switch in mindset?
When I started my investing journey in 94, at that time I focused mainly on compounders. So I didn't start out being a Ben Graham investor. I started out being more a Munger investor, looking for great businesses that had very strong growth engines. That worked very, very well from 94 till about 99 or 2000. But as we got closer to 99, 2000, there was a very serious bubble in the US equity markets. We had the big dot-com bubble. It was clear to me in late 99, even mid 99, that it was a bubble likely to pop. I had no idea when or how it would pop, but it was likely to pop. I did not want to expose myself to that. So at that point, about 99 or so, I made a switch where I went back to Graham type of investing. And what was happening in the US markets at that time was that very basic but good businesses were undervalued, whereas these hyped up businesses were pets.com, Chemdex, and so on were at stratospheric values. And so the day, for example, the day the NASDAQ peaked, I think like March 7th or March 9th, 2000, was the day that Berkshire hit a multi-year low. So literally people were pulling money out of Berkshire and putting it into pets.com. So I, at that point, was investing heavily into very basic businesses, funeral homes, and such. And that worked very well. What I forgot to do, because it felt so comfortable and that bubble was such a massive bubble, that I continued running down the Graham path for the next almost 20 years. And what I should have done is I should have probably, the ideal time to have switched back to great compounders would have been in the 2009 to 2012 timeframe. I think at that point, between 2009 and 12, is when markets had corrected well enough that valuations had become more reasonable and what one could again look at great compounders. But I had become so entrenched in the deep value area and had done so well over that period. So, for example, from 99, 2000 until 2007, I was compounding at mid 30s% a year, while the S&P, when Nasdaq had crashed, and the S&P and the Dow were like low single digits in that period. They were struggling because they were so elevated in valuations. But then in 2020, I read the chapter on Nick Sleep and Nick and Zak in William Green's book. I realized that I needed to go back to, in the end, the best place to invest is a great growing business. That's really where you need to be. The issue is that you need to be careful how much you're paying. So every business has a value, and we want to be buying things for well below that value. So buying great businesses at 80 times earnings typically is not going to be a great way to get rich. I made the switch back. I was already used to the compounders and all of that. And I just need to kind of reset my frameworks. And I've been in the process of doing that. Yes.